Occidental Petroleum strongly beat Q2 2026 consensus today. Adjusted EPS came in at $2.40, just completely crushing the $1.86 estimate.
Yeah, and revenue hit $8.33 billion.
Right, versus the $7.2 billion consensus. And looking forward, management actually raised full year 2026 production guidance.
To, what was it, between 1.42 and 1.45 million barrels of oil equivalent per day.
Exactly. Plus, they boosted midstream pre-tax income targets by, like, $300 million.
Which is huge. And the stock reacted, very bullishly after that.
Yeah, it rallied roughly 4% in after hours in the following regular session on, like, really heavy volume.
Basically erasing that whole pre-earnings macro-driven dip.
Right, so for this deep dive, we're taking Occidental's earnings report and the latest analyst notes to figure out how they engineered this massive quarter. I mean, was it just elevated crude prices or sheer operational execution?
Well, if you're holding OXY stock right now, you might glance at those headline numbers and just assume they got a lift from crude prices.
Right, yeah.
But the underlying data tells a totally different story. Global production topped the high end of their guidance.
Wow.
And crucially, their domestic lease operating expense, their LOE, dropped to just $7.80 per barrel.
Which makes total sense when you look at the mechanics,
Right.
By pushing higher base production volumes through their existing infrastructure, they effectively dilute those fixed lease operating costs.
Exactly. You're spreading the exact same overhead across a larger number of barrels.
Right. But the segment that really carried this quarter, I mean, basically the offensive line of this report was midstream and marketing.
Oh, yeah. They pulled in a record $960 million in pre-tax income.
Wait, really? That's insane, because that more than doubles their midpoint guidance. But I have to ask you, is that $960 million figure a structural improvement we can rely on, or do they just get lucky with cargo timing?
Well, looking at the notes, it's definitely a structural win. Yes, they benefited from a surge in sulfur prices at Al Hosn.
Sure.
But the real driver was gas transportation optimization. You kind of have to think of their midstream network less like a static pipeline and more like dynamic toll pricing on a highway.
Right. They built the physical infrastructure so that the second chemical spreads widen in the market. They just automatically route product to capture those higher margins.
Exactly. And that structural agility is exactly why management raised the full-year midstream guidance by $300 million.
Right. They aren't banking on those specific commodity spikes lasting forever.
No, but they know their system is primed to capture the upside when it inevitably happens.
And that agility translated directly into a massive $3 billion free cash flow windfall this quarter.
Yeah, and we are seeing the new CEO, Richard Jackson, use that cash with intense discipline.
Right, moving away from past acquisition sprees like when they sold OxyChem for $9.7 billion. They retired $1.9 billion in principal debt in Q2 alone.
Bringing their total debt down to $11.8 billion.
Which puts that massive $10 billion milestone target right within striking distance.
Yeah, and they even bumped the dividend by 8%. But that disciplined debt paydown is really the foundation for their next big promise to investors.
Right. The target of $4 billion in incremental annual sustainable cash flow by 2030.
And management claims 85% of that is achievable even if oil prices drop.
See, I had to push back on that 2030 target, though.
Really? How come?
Well, to hit those numbers, they are relying so heavily on advanced recovery technology to artificially reduce their base decline rates to 20%. That feels incredibly optimistic given the geology.
It does. The analysts agree it is absolutely the biggest execution risk in the entire report. To slow that decline rate, they're banking on complex water flooding and CO2-enhanced recovery projects.
Meaning they're literally injecting water and carbon dioxide down into the reservoir to increase subsurface pressure.
Right. Physically sweeping the remaining trapped oil toward the producing wells. That's the mechanism.
But if that subsurface physics doesn't work out as modeled, that $4 billion cash flow target just vanishes.
Exactly. They would be forced to ramp up capital expenditures to drill brand new wells just to maintain production.
Totally wrecking the capital discipline narrative.
Yeah. And we also have to ground this deep dive in the immediate risks facing the stock right now.
Right. Looking at Q3 headwinds, we've got Gulf of Mexico maintenance and, weather contingencies expected to pull back production sequentially.
But the most critical risk for you, the listener, if you're watching this talk, is that Occidental operates largely unhedged.
Right. They are completely exposed to the open market.
Exactly. If an OPEC plus supply glut materializes, OXY lacks a financial safety net against plunging WTI prices.
They are executing brilliantly on the operations side right now, but a sudden drop in crude changes the entire game.
It really leaves you with a fascinating tension.
Yeah, so think about this. If Occidental hits that 10 billion debt target ahead of schedule and redeems its 8.5 billion in preferred equity by 2029, will it evolve into just a pure cash return machine?
Or will that unhedged commodity exposure inevitably force another strategic pivot the second the market turns?
It's a great question to ponder. Keep an eye on those decline rates and make sure to follow the show for your daily earnings coverage.